Welcome to the Retiring Real Estate Investor Podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Welcome to the Retiring Real Estate Investor Podcast. I am one of your co-hosts, Brandon Bruckman. We've given our other co-host, Josh Wright, the day off. How nice of us. But we've filled in a lot of space here with Ted Greene from Spartan. Ted, how are you?
Hi, Brendan. I am good. Thanks for having me. Pleasure to be here.
Awesome. Yeah, this is great. I've been excited to kind of get you on, and we're gonna dive into, we're gonna talk about self-storage. Do you remember when people didn't like self-storage? Because I feel like it's so it's so popular. It feels like there was a time and period where self-storage was out of vogue, right?
I not only do I remember that, I also remember a day when most investors had most of their assets in the stock market, which to me makes my stomach hurt and my palms sweat after 25 years in the business. So I remember that and how things have changed.
Yeah, we've come a long way, and there's much more to go. That might be a good side episode as I think about like episodes in the future. I'd love to talk about like the evolution of like the personal investor from equities to now venturing their way into, and still I think dipping a toe into this alternative. I don't even like that terminology. So there's a lot to unpack there, right? About just how that's set up. I don't even like the terminology alternative. It just implies now just something that isn't stocks and bonds, but so much more than that. And you guys are part of that. So maybe let's start here. Give us a bit of a background of how you got to Spartan, and then maybe some of Spartan's history as well.
Yeah. So I'm in my mid-50s. Out of college, I started as an intern at Merrill Lynch. I turned that into 15 years. I bailed when Bank of America bought Merrill Lynch. I was a chief compliance officer for an RIA, a small RIA, for 6 years. And a friend of mine from the early 90s at Merrill Lynch wanted to start a self-directed IRA facilitation firm, which we did. We subsequently sold that to Yield Street in 2019. I'd done a lot of work with Spartan Investment Group during my years at WealthFlex, now Yield Street, and got to know the owners at Spartan, saw some of their projects run full cycle, and was just really impressed with Ryan and the senior leadership. Switching to Spartan, let me finish that. So in the summer of 2020, when my earnout with Yield Street concluded, I joined the Spartan team with, I got 1 week of vacation, I got a paycheck. It wasn't life-changing, but it was worth doing. And then, so I started with Spartan. By way of Spartan, Spartan is now 10 years old, has been focused solely on self-storage since 2017. We do value-add construction as well as ground-up construction, and focus solely on self-storage as a syndicator and a fully integrated self-storage manager.
Oh, perfect. So it's interesting you kind of come to this real estate side of the equation from probably a very similar background that myself and maybe a little bit of Josh come from as well, as I don't come from this from a real estate perspective either. It's definitely more public markets driven, more from the equity side of the equation. Were there anything that struck you when you came to real estate where you're like, man, no one told me about how cool this was?
You can't amplify that message loudly enough, Brandon. You know, in conversations that I had with Josh in Kansas City the other day, It turns out we know a lot of the same programmers
Mhm.
that run in circles in the alt space. It's bananas the degree to, I mean, just look at, so here we are, this is September of 2022. Look at the volatility in the stock market and look how the long end of the yield curve is behaving. Prices were up on the 20-year bond and yields were down when yesterday the Fed says they're raising rates on the short end. And so,
Mhm.
the volatility, people are really starting to freak out. And the stock market, it's been, we're going to go back down and retest the lows. So you've got the stock market, and then you've got this word alternative, which, yeah, maybe it's not the strongest word. Maybe the better word is stable investment. I mean, yeah, there's no liquidity in some syndicated investments, but there's no volatility, or that's actually the wrong word. There's less volatility, and it's more stable assets frequently, not always, but frequently. They're just simply more stable assets. And there's studies, endless amounts of studies that demonstrate the value of all types of real estate. But if I had known 20 years ago what I know now, bananas, just bananas.
Yeah. Yeah, I self-admittedly, and I've said this a few times, like I've shunned real estate in the past because of the liquidity item that you mentioned, and that was drilled into my head from my background and training that illiquidity is this, um, scarlet letter thing that I don't want access to. I don't want illiquidity. The part that folks miss to mention, especially for the individual investor, boy, the tax advantages here are through the roof. We could spend a whole episode talking about that. But there is a psychological component too to kind of play on your comments. Is every single day, even our investors are able to log into their account and see how they're performing. You don't do that with these real estate investments, even though there is an underlying. We just don't have a mark to market mechanism there, and it's probably psychologically helpful for folks is to get your distribution check every month or every quarter, and not worry about the underlying value because we're not selling today, and we're probably not selling tomorrow. So go on with your day, please.
Yeah, and there's a cost to that liquidity. You look at any closed-end three-letter symbol fund that is a fixed income type of investment, and over the last 18 months, as the yield curve has started to move, there's been a lot of value that has been lost there for the sake of liquidity. So it's not it shouldn't bring the negative connotation. I heard the saying, discipline brings freedom, just like last week somebody shared that with me, and in this situation, have the amount of cash that is appropriate for you and your family or your business, so that you don't need liquidity from other investments.
Mhm.
So there's a solution to the illiquidity component, is my point.
100%, 100%, and that's part of what we're helping our clients think about every day. Is there's a certain amount of liquid cash you have to have on hand, and no, it's not a benchmark amount or number. Right? It's something that ultimately becomes very personal
Yeah.
and very adaptable to your lifestyle. Let's figure out what that number is, and then go off and invest the rest of it. Because that's how we build wealth.
And ladder those securities, be it publicly traded or private. But and you as an advisor, Brandon, you can coach your investors through that. But as long as there's some kind of sequential laddering to the investment change, so that funds are coming due with some frequency, that solves the illiquidity issue.
Yep. And then we're off chasing good investments, which is the whole point of sort of what we're doing. And that's where you guys come into the equation. So talk a little bit about, and we could spend like 3 hours talking about just the self-storage market. So maybe give us the top down kind of where you see the market for storage. And I'll prompt you a little bit in saying that we've seen some of the, call them bigger indicators around sort of the amount of construction we've seen in storage has exploded over the past maybe say half decade or so. Is any of that worrisome as you sort of look at the storage space?
100%. Very worrisome. With that being said, there's ways to manage that risk. It takes 18 months to get a permit to do construction. Certainly new construction, that can take 2.5 years. So in markets where there is tight occupancy, no permits in process for significant competition, strong migration patterns, strong employment growth patterns, strong patterns by way of the state tax rate and whether or not it's, drawing businesses and individuals in. You get your hands around that. And by the way, we have a team of 3 that just do due diligence on the properties that we're currently evaluating. It's hard for the little guy or the guy that's got the day job or the gal that's got the day job. I don't want to create the wrong image there, but for folks who have a day job and trying to raise capital at night for a side hustle, that's worrisome. At Spartan, we've got over 100 employees. Acquisitions team has 3. The due diligence team has 3 people. That's all they do. So you can filter out those risks, Brandon, that you alluded to, and germinate the ideas that are the best of the best of the best, and then focus on those and continue to drill down. And investors should not want to work with a sponsor who only makes money when they acquire and develop. There's a balancing act there where you want to be working with someone so that the investor needs the sponsor more than the sponsor needs the investor. And that's a tough question to ask, but as an investor, the investor should feel comfortable asking that, along with, can the sponsor continue to raise capital should the project get into trouble? Because if you can't get out of trouble, you've got a real problem. But back to the question, there's a lot of construction happening that you can sift through that and find the gems among the rough. Case you're personally invested in a deal that our first project that we acquired in Storage Fund 1, some of the lease rates had not been increased on that property since the mid-1990s.
Wow.
If you had asked me, does that deal exist before we close on that property on June 30th, I would have said no. But now that we've closed on it, we're going to double the lease rates in the next 12 months on that Havelock, North Carolina property. So there are some gems in the rough out there, Brendan, but there's also a lot of risk out there, and you got to be able to sift through all that.
Yeah. So when I hear that, it's some insight for our listeners. Yes, we are invested in Storage One, just for transparency purposes. Some of our investors are as well. And we've done some on-sites too, with yourself and the rest of the team, to look at some of these properties. And so it feels like on the massive increase we've seen in construction of these types of properties, that is not spread equally throughout markets. That feels like it's very concentrated, and correct me if I'm wrong, very concentrated in major metro areas. And that leaves a world of opportunity for other markets that you mentioned where, there has been more of a, let's call it mom and pop operation going on there, or there's just not the kind of permitting available to really suit the population. There's still a giant demand need and less supply, despite that big U.S. construction number we're seeing. It just isn't the same in every market. Is that fair to say?
That's very fair to say. And Spartan, on the whole, Spartan prefers shoulder communities or communities that are not in the downtown core, because we don't want to get in a fist fight with CubeSmart or Public or any of the 800-pound gorillas. They can hold their breath longer than we can. Conversely, if we go 30 minutes outside of the downtown core, we have an owner operator who's got a much less institutional mindset, meaning when we come in and take control, we now have 58 properties, a team of over 100 employees at Spartan. We've got that institutional mindset, and we can apply that to a Class B or a Class B plus property, transform it into a Class A minus property. We know what we need to be getting on a per square foot. We know what the minimum square footage size is. We know how to institutionalize the asset, and we know how to mitigate the risk before we close on the property to make sure we're not going to be just down the street from an 800-pound gorilla. So, and these animals cash flow at 5% plus. So if you're starting at cash on cash at 5 and a preferred return of 7, and those are some $20 words, and investors, if you talk to Brandon for explanation of the terms, but These are strong cash flowing assets that for folks my age and 60-year-olds who are, there's not much available in the bond market. And if we have a recession and the Fed has to lower interest rates, there's going to be a lot less in the bond market in 18 months from now or 2 years from now. And there may be a lot less in the stock market for you. So for folks that are trying to plan for income in retirement, these types of assets, they're seemingly stable. They provide strong cash flow and strong tax incentives or tax benefits that we might want to touch on as well.
And that's interesting how you just describe that. And I think my next question was around some of the underwriting process that you guys use and the assets that you focused on. You sort of answered that, but you want to kind of wrap that in a bow for us in terms of exactly what Spartan's looking for in the acquisition or development of some of those assets.
Yeah. So at the end of the day, we really want to have the investor get to a minimum of 15% internal rate of return. Now, that's a fancy $20 word. What does that really mean? I'll say the same thing a couple of different ways in the next couple of minutes here, but in the short version is we're looking to have the investor double their money in 5 years. The supporting terms there are equity multiple of 2, and the amount of time is 5 years. So another way to say that is going back to the internal rate of return, there's some cash flow, and then there's a capital gain we anticipate. So to have an internal rate of return of 15% or 17%, you're measuring the present value of your future streams of cash flow plus the present value of your future capital gain. But you pack all of that together, and Spartan's only going to bring a deal to an investor if we think minimum the investor can get a 15 IRR, and that's an equity multiple of 2 over 5 years, loosely fitting those two themes together is what we're looking for. So after all the due diligence, after all the underwriting, after being evaluative of the financing package from the lender, the cash on cash, the distributable net operating income, you look at all that stuff. And at the end of the day, if it doesn't get over that bar that I articulated, then we're just not going to do it for the investor. And that's why, from my perspective, fiduciaries like yourself that are sifting through, you go to Veravest, you can find all kinds of sponsors that have a good track record. So it's really the best of the best of the best that an RIA or a fiduciary is putting in front of their investors. And if you can squeeze that standard deviation of returns, like I remember I was at Merrill Lynch in 2000 to 2002. And that was, the NASDAQ was down 75%. So the dispersion of returns is very wide, big losses, big gains over lots of years. But if you can squeeze your standard deviation down so you're making consistent singles and doubles, the investor is going to be a lot easier emotionally, and financially it's a lot better as well.
Yeah, 100%. And you mentioned some of the terminology there and explained the IRRs and the equity multiples. Everyone who listens to this show has to pass a written test first. So they're all very familiar with. I'm kidding. No, we don't make people do that. we might someday. I don't know. That could be a fun show. The quiz show, the IRR quiz show.
You got me on that one.
Make folks do some calculations before they log on. No, I'm kidding. No, that's perfect. And I think when you think about the storage assets, what's so interesting as we look back through the history of these is I believe the best performing asset during 08-09 crisis from a real estate perspective. And then you watched COVID happen, and we kind of, and this is very qualitative, we kind of poked around in some of the self-storage we were in, and occupancy was rising, and we're going, really, what's going on? Just at the start of COVID, we're like, what's the deal here? It's like, well, it's college kids moving out of some of these areas, and need a place to store their stuff. I'm like, wow, that's right. Like, they're leaving campus, they're being kicked out because of COVID. And sort of the realization sort of hit us, like, is self-storage this asset that just continuously performs in any kind of market condition? Is it not subject to some of these cyclical items that we get concerned about and always producing returns? Do you guys kind of look at it that way, sort of? So when we think about some of those hurdle rates, are those even achievable if we're into a deeper recession that we are now, or in the inflationary environment?
Yeah. So you've touched on what I think is the most important piece when it comes to allocating capital. Ryan, Scott, and Ben, well, let's pick on Ryan and Scott for a minute. Scott's a retired major from the U.S. Army. He led in Operation Freedom in Iraq. There's one guy that does not want to get caught in a bad situation. He's got to have an exit plan at all times. And Ryan was a commercial airline pilot for his career before Spartan. He doesn't want to get in a bad situation. People die when those two guys in those two career paths, if they get in trouble, people can die. So that was the frame of mind that they came to at 2017, where they spent a lot of time being evaluative of what asset class do we want to participate in. And it was not how much can we make, it was totally how much could be lost. And that's a great perspective when it comes to folks my age. Well, I think of anybody of any age, they ought to be thinking about not how much can I make, but how bad can this get? So speaking of COVID, a very interesting fact is that occupancy is driven by life events. A business that unfortunately needs to close in COVID. Do you fire sale everything, or do you put it in storage and wait for a better day? Business owners that want to shrink the retail footprint of their retail space, storage is a much cheaper place to keep inventory than is, a strip mall square footage. When you need to work from home, you don't want to sell your $1 million home to buy a $1.3 million home just for an extra bedroom. You can put some stuff in storage and shuffle and just figure it out. So anyway, life event happens. My sense is we're headed for a recession. My sense is people have life events when you have a recession. You just got to shuffle things around. So interestingly, from the summer of 2020 to the summer of 2021, lease rates for the industry were up 13% with no regard to climate controlled or not climate controlled, Class C or Class A, no regard, 13% for the industry. And when you think about it, the market value of an asset is dictated by the delta or the change in net operating income divided by the cap rate. Again, just to summarize, the incremental net operating income divided by a cap rate. So if you can increase your lease rates by 13% or expand the footprint of your property as well as increasing the lease rates, so that's going to constitute the change in NOI, and then divide that by 0.045 or 0.05 or what have you, and you're creating $5-7 million of incremental market value just because, number one, you're not picking a fight with CubeSmart or Public. That's an easy one. So don't buy in the wrong location. But number two, get your construction team in there quick, expand it, lease it up, and get out and move on. And so storage is very resilient in recessions when looking backwards. That's not a proclamation or promissory language of future performance, but it sure gives me a lot of comfort that the asset is durable and strong.
It's like I can always seem like there's a base case for usage of storage. And you encapsulate it very well in terms of life events.
Yeah.
Like when life events happen in any sort of market condition, we see a robust economy. People are buying more stuff and they need to put it somewhere, storage. Yeah. We see a recession. People need to downsize and restructure and think about getting smaller, storage, right? And it always seems to end with there's a demand or a market for storage in some way. On top of that, and I don't think a lot of people know this, most of the leases that you're looking at here are month to month, correct? You're able to move rents. So as we see this 9%, and some say it's a lot more, but let's call it 9% inflation year on year, we're able to take advantage of that in storage, correct?
That's correct. Yeah. Now, truth be told, when we're leasing up a newly constructed unit, we're going to float deals or give a first 3 months at $15, and then the back 3 months, those are going to float to market. For the sake of transparency, different situations bring a different approach, but there are no tenancy laws. If a tenant is more than 5 days late, we provide the notice to evict. 30 days later, the stuff gets auctioned. We don't keep the proceeds. It's not like it is represented on TV. The tenants take all the good stuff and they're gone, but at least we get the unit back on the market, and and it's cash flow positive off the unit, soon thereafter. So it's easy to own, easy to evict, and easy to maintain.
From that aspect, is there really, are the challenges here around managing more analytical and thinking about occupancy versus lease rates? Is that where the biggest challenge comes into play, as opposed to our multifamily friends who are really worrying a lot about those 3Ts every month? Not so much for the storage management.
Storage is hard to screw up if you've bought the right property. I mean, it really is. There's real complexity. You want to know how many 10 by 10s you've got left, and you don't want to keep the same pricing as you get down to, if you've got 150 10 by 10s at a given location. When you get down to 20 10 by 10s that are vacant, you want to start bumping that lease rate up, and you want to apply that institutional knowledge and push it as far as you can so that you're getting every last dollar you can out of the property. But provided you buy the right property, and provided you don't have, eminent domain or something that's going to jack up your business plan, it's kind of hard to mess it up, because you got one toilet, you got one property manager. It's concrete and steel, and it's kind of hard to mess up, provided that you've bought the right property. And that's why we focus so much on the due diligence piece, because it's kind of like that proverbial cow that's just there producing. I mean, it's kind of hard to screw it up.
It sounds like something I could manage. When we think about like the big boys like CubeSmart, you've mentioned them a few times. Are they simply playing a different game than we are? I realize it's storage too, but considering the size and the volume of these large gorillas in this marketplace, are they simply just playing a different sport than we are?
To a degree, yes. There's a lot of institutional money, pension funds. It's actually interesting. I wrote an article about this for another sponsor about 18 months ago, and this was back in August of 2020, when the Department of Labor made a change to what ERISA plans, 401k plans, 403bs, what those plans can invest in with their life cycle funds. And those are the funds in the retirement plan. My dear wife, Melissa, she doesn't like tinkering with her 401k allocation. So she's got her 2035 retirement fund, and the administrator handles that asset allocation. Well, back in the summer of 2020, Department of Labor allowed ERISA to allow private investments in the life cycle fund allocation. What that means is these massive 401k plans, think of ExxonMobil or Boeing or your big Fortune 500 company 401k plan, they want to place 300 million or 500 million into various alternative, there's that word again, very alternative assets that don't bring the volatility and the complexity of the stock market, and they provide sustainable cash flow. So those entities are placing capital into high quality assets. And so the Class A, CubeSmart, those guys, what they're really doing is they're playing the big dollar game that is providing low standard deviation of returns. And so you've got all kinds of institutional money in that asset class. For Spartan, we're a bottom end of the middle market or the top end of the small market. So we're an $80 million asset, or we're a $120 million asset. And I think of $100 million as the cut between small market and the lower end of middle market. So the institutional capital, it's not really there yet. However, Brandon, the asset that I met you at over in Wisconsin, that is an asset that, one of the largest private equity firms in the world has said, we want that. And so Spartan's plan is to consolidate these assets. And let me qualify this. I'm not part of leadership. I don't have a seat at the table in the decisions. Leadership has been very vocal. We're all about maximum and the most amount of options. So maximum optionality, we call it. So in other words, the institutions are selling those Class A assets into the CalPERS of the world, or the large pension funds. And we're looking to the degree that we can, maximize the opportunity to take our Class Bs and improve them, take our Class As and start to do, over a series of years, consecutive large market sales, so that we're monetizing 300 million or 400 million of assets in a transaction. And that cap rate compression, and pardon me for going so long, but this is so
No.
meaningful. If you take an individual asset that you've bought at a 5 cap, if you consolidate that with 25 or 35 other properties, and the constitution or the total amount there is 400 million, and you can transact that at a 4 cap, that's a 25% increase in market value by taking it from a 5 cap to a 4 cap. It's very significant. And if you think about what we're headed into, recession, lower interest rates, probably 18 months from now, my best guess, I don't know. But if you think about what that cap rate compression looks like because you've institutionalized this whole mindset, it's really significant from an equity multiple, internal rate of return, and capital gain perspective. And you layer on the bonus depreciation for the taxable investor. And then you put on the secret sauce of you folks with your 1031, magic tricks that you're playing. I mean, it's bananas. It's very compelling. It's not bananas.
Yeah, there's an interesting life cycle here of the way that you're able to, and we've seen this play out in larger portfolios that we've been shown in the 1031 space. They will get separate appraisal, one appraisal on a per property level, and another appraisal for the portfolio. And so I can see that value being created on the other end of the equation where someone's acquiring that at a value that's greater than the individual property's appraised value. So I can see it. So for our investors that are looking at this and thinking about storage, this is very real in that there's an ability for Spartan to take these assets that are standalone, not attractive to large pools of capital, consolidate them and make them attractive to them. In doing that, you're creating value in and at itself. Before we even talk about improving some of the rental rates or the occupancy, before even that happens, or this is the cherry on top, is able to do the consolidation and improve the cap rate that way and create value for investors immediately.
Brandon, we talked maybe 10 minutes ago about the frame of mind from 10 and 20 years ago that we both had and what we didn't know 10 and 20 years ago. And I just hope that investors really take the time to stop and think. Don't be impetuous. Just stop and think. The point that you just made is so impactful and can extract so much volatility from someone's financial life, which when you think about it, the anxiety that comes from volatility in the stock market is very powerful. And I know for myself, my kids are transitioning to college. My wife and I were close to being empty nesters. I don't need that kind of emotional, herky-jerky noise. I want to focus on going for a walk with Melissa when I get home from work and just enjoying her and not being worried about blah, blah, blah. That's just me.
Yeah, no, you're not alone. You're not alone. We have a lot of investors, and we're with that mindset as well as we think about constructing portfolios for folks. It's a mix of all these things, but it's ultimately something that you stop worrying about. And so it's my job to worry about it. Let me stay up at night and worry about how things are going and how we're going to react to that. And let's take that off your shoulders 100%. So let me spin you a little bit and talk about, as a sponsor and as a syndicator, what are some of the most challenging parts of just the formation of some of these structures to get investors in from a syndication? And now you guys are looking at that fund structure. Are there any pros or cons between those two structures for you guys?
Yeah, that's a really interesting question. And the very blunt answer will probably surprise you. The complexity that a 30-person firm has is different than the complexity of 110 employees. And it has less to do with the fact that we're a self-storage sponsor, and it has more to do with when you have 100 employees, the systems that you used when you have 30 employees, those systems break. And so you have to find a new way to communicate, share that information, and continue to scale. And we're solving for that. But what we've realized is we have maximized and this would be the case if we are an airline manufacturer, a software company, or a self-storage sponsor. There's just a different dynamic to a 100-employee company than a small company. So I would say that's probably the first challenge that we're dealing with. Right behind that, I would say the following: the market right now is able to see through the Fed funds rate increases and is beginning to see, okay, we're going to have a hard landing. This is my opinion. This is not investment advice. But I think the market is starting to see we're going to have, there's potential for a hard landing economically and not a soft landing where the Fed just hits the nail right on ahead and this is perfect. So property owners, and this is why we're closing our fund in the next 6 weeks, property owners are seeing, okay, the Fed's raising interest rates, but they're going to cause a recession, and then they're going to have to lower interest rates. My property produces cash. Even though interest rates are going up, and typically you'd see cap rates move higher and property values move lower when you have interest rates going up. Well, property owners are saying, no, I'm not going to lower the value of my property and sell it. I'm not going to transact at a lower price, which correlates with a higher cap rate. I'm just going to sit tight and hold it. And so the market can come to me in 18 months because I'm seeing a recession. I'm seeing the Fed is likely going to have to retreat with interest rates and undo what they're doing right now. And by the way, it's my opinion. Who am I? I'm not an investment advisor, but it's my opinion. It takes 12 to 18 months for the economy to really feel the results of what the Fed is doing. So I understand property owners. They just won't lower the price of their property. The expense to buy has come up. In June of this year, we were at 3.55 yield on the 10-year bond. We've retreated some since then. But so this is an interesting time where it's harder to buy a property, and owners, they're just not willing to retreat on price. So it's a new recent dynamic that has entered the market the last 6 months, and it just demonstrates that when the economy slows, the money has a hard time finding the asset that's throwing off cash. And that's why those values go up and yields go down. And in 2023, I think that's the environment we'll be in. And so the investor likely needs to, well, I can't give investment advice, but for me and my family, I want to own those assets before the recession hits. I'm not an investment advisor. That's just my opinion.
This podcast is for informational purposes only. Any investment advice is not. Don't worry, we disclaimer the heck out of it. So I'm with you too. On it. But it is such an interesting dynamic that you described that I can't really wrap my head around, because I believe we should see higher cap rates. I don't know how we can't, but it's also because we're seeing a couple of things is a reluctance to sell into that. Why would I sell? Right? I'll just hold the asset. Right. And then at the same time, though, I'm still watching very eager buyers at lower cap rates, which I can't get a grip in my brain around that. It just doesn't line up for me. Yeah. I'm watching people continue to buy with higher debt at low cap rates still. And I'm looking at that from just a total return basis perspective and going, well, guess what? The 10-year bond looks a lot more interesting at a risk-free rate than maybe some of the returns that you're getting off of these assets. And I can't reconcile it quite yet on why that's happening, but it is vastly interesting.
There's an interesting complexity there, and I'm going to go full nerd here for a moment. But that's what
we're looking for.
well,
excellent.
So Investopedia, they provide definitions of financial terms. So in the bond market, there is something called the bull steepener. If you look at Merrill Lynch, 15 years, industry for a couple of decades, if you talk to a stock guy versus a bond guy, you're going to get two different opinions.
Yes.
And the bond guys would say the following. A bull steepener is what you get when money flows into the short end of the curve to buy those bonds, pushing those prices up and compressing the yield down. And this is the short end of the curve, whereas this direction is the 10-year, the 20-year, and the 30-year. So in the 1 to 3 year, you can have the yield curve come down and bond prices go up because capital's coming there before the Fed starts to lower interest rates. One comment that I heard recently was a reminder from David Rosenberg, used to be the chief economist at Merrill Lynch from 1993 through 2000. For 7 years, he was an All-American institutional analyst. For those in the business, that's a big statement. To be All-American is a big statement. Anyway, one of his reminders from his podcast recently was the following. Remember, in the 11 recessions that we've had since the 1950s, generally speaking, the yield on the stock market matches the yield on the 10-year government bond at the inflection point where the bear turns into the bull. If we think about that, we're at 170 for the yield for the stock market, and currently we're at, on the 10-year, I think we're about 280 to 3.0. So you could drive a truck through the disparity in the yield for the stock market versus the yield for the 10-year. So what that means is the institutional money, generally speaking, comes into the bond market before the Fed does its thing and you get the bull steepener. So the point being, financing will get better. And I think the property owners know that they just don't need to retreat on price because they're looking across the valley of a recession. Now, that's just my best guess. I could be dead wrong, and it's happened before. But that's the way I interpret it. I don't think the cap rates need to go higher. I think we're going to have a recession, and the property owner is actually going to be proved right. The value of that cash flowing asset, it's going to be there, and they're just not going to give ground for the next 9 months before the Fed starts to pivot and go the other way with interest rates. Brandon, what do I know?
Yeah. What do we know? Yeah. Two big takeaways there. One, listen to the debt guys, not the equity guys. Sorry, equity guys. And also, as someone who worked at a hedge fund for a long time, you'd be surprised at how many folks I see looking at Investopedia on almost a daily basis.
Interesting.
To understand some of this terminology,
yeah.
Which is humbling and scary both at the exact same time.
Yeah. Yeah. The world is a big, complex place. I think what we just said, it's very complex.
It certainly is. It certainly is. Oh, this has been great. This has been awesome. I think we've learned a ton about storage. We've gotten really good insight into the way that you guys are looking at property, and then turning around and creating value in this space is really a big thing that investors need to think about as well. There's sort of natural economics that you're getting from adding value to these properties and positioning them for sale, which is huge to think about too. Do you have, other than taking walks with your wife, is there anything else you love to do in your free time?
Boy, so my son plays baseball in college. He's a pitcher. So we try to get over to Spokane, Washington as frequently as we can to see him play. My daughter and her sports activities with soccer, I don't think there's anything particularly unique about Melissa and I. I'm getting to the age where I'm getting a little bit salty. Yeah, I just don't have the tolerance for wasting my time and for being concerned about needless things. So I'm just trying to whittle down on the noise in life and focus more on the things that bring me joy.
I was sitting at a high school football game last weekend with someone of my similar age group, and we were getting excited about, man, it'd be fun to be at home and just not doing anything and just relaxing with the family. And I'm like, oh man, we're crossing the paradigm here into getting. I hope I'm getting salties coming soon for me as well.
Sounds like you're there, dude.
Oh man, looking forward to it. I'm looking forward to getting there. As always with all of our guests, if you want to learn more about Spartan, you can always reach out to us at Insight, and we can talk you through that. But I encourage you to go learn more about Spartan yourselves as well. Ted, where can people learn more about you guys and Spartan?
So Spartan Investment Group, the URL for us, or the web address, is spartan-investors.com, and you can always find me on LinkedIn. I've got an E on the end of Green. And, as part of the investor relations team, I think the thing that I enjoy most is just connecting with investors and talking about how bad it can get, how good it can get, and just building that relationship.
That's outstanding. We'll link that stuff up in the show notes so that folks can find you. Again, Ted, this has been awesome. Thank you so much for the time.
I really enjoyed it. Let's do it again soon.
There you go. All right, everyone, take care. Thanks for listening.